The market is clearly reacting strongly to ON Holding AG, ticker ONON, with the stock currently sitting at $38.40, reflecting a significant jump of 9.15% for the day. This is a powerful, sudden move, especially when you consider where the stock has been trading lately, hovering precariously close to its 52-week lows in the mid-$34 range. The expectation, which has been baked into the stock's performance over the last several months, was one of deceleration, particularly in the face of what many analysts and investors saw as an overly aggressive valuation in a crowded, competitive sportswear market. After a dismal second-quarter earnings report back in August, which saw the company miss EPS estimates by a wide margin, the general belief was that the momentum was gone, that the shine had worn off the premium running shoe brand. The reality, however, delivered this morning is a stark contrast, an unexpectedly strong third-quarter report that is forcing a major reevaluation. The stock is soaring because the numbers significantly exceeded both sales and profitability consensus, a clear indication that the growth story, which everyone thought was hitting the wall, still has significant legs, even if the general market sentiment has been extremely negative leading up to this point. This sudden surge in ONON stock, pushing it well off those recent lows, tells you everything you need to know about the shock of this quarter's performance. The tension between expectation and reality here is everything. The street was bracing for more gloom, a continuation of the weakness seen in the Americas region, which is a major concern given the overall size of the U.S. market. Instead, ON reported a net sales increase of nearly 25% year-over-year, and on a constant currency basis, that growth looks even better, clocking in at 34.5%, with revenues reaching an impressive CHF 794.4 million CHF. Crucially, the adjusted EBITDA margin came in at a remarkable 22.6%, crushing the consensus expectation of around 18.6%. It's this profitability beat, demonstrating disciplined cost control and the strength of their premium pricing, that is the core of today's upward movement. The market had mentally downgraded ON from a pure high-growth play to a company struggling with margin compression and slowing distribution, especially with rivals like Nike stepping up their game. This quarter delivers a serious counterpunch to that narrative. Volume today has been astronomical, significantly higher than the 30-day average, indicating a massive short covering squeeze, combined with institutional investors rapidly buying to establish new positions or cover their underweight status. When a stock trades with this kind of volume on an earnings beat, it's a strong sign that the sell-side analysts and portfolio managers were caught entirely off guard. The negative sentiment that had been built up over the past few quarters is now unwinding violently. We can't ignore the geopolitical and macroeconomic backdrop, which also plays into the daily swings of ONON stock. The general deceleration in consumer spending, particularly on non-essential, premium items, has been a significant headwind for the entire apparel and footwear sector. Companies like Lululemon and others have seen caution in their forward-looking statements, yet ON is managing to defy this, largely due to phenomenal performance in specific categories and geographies. Their apparel category, a segment that many analysts were deeply skeptical of, showed triple-digit growth on a constant currency basis, demonstrating that the brand is successfully extending beyond its core running shoe base. Furthermore, the Asia-Pacific region delivered a fourth consecutive triple-digit constant currency growth, a fact that is easy for U.S.-centric investors to overlook, but is undeniably material to the global growth story. It's this multi-dimensional growth, not just in shoes but in apparel, and not just in the U.S. but globally, that provides the depth to the surprise. This isn't a one-trick pony relying on an old trend. It's a premium brand executing strategically on diversification, which is a key metric an investor looking at fidelity or managing an intelligent portfolio would want to see. Now, let's establish some common ground about the business itself for those new to this stock. On Holding AG, co-founded by an Ironman champion, is a Swiss performance sports brand known for its distinctive cloud tech cushioning technology in running shoes. The technology, characterized by hollow pods on the outsole, is what differentiates its products. Their core business model is premium positioning and multi-channel distribution, a mix of high-margin direct-to-consumer (DTC) sales through their website and physical stores, and a wide wholesale network through specialty running stores and premium retailers. This model is why their gross margins have historically been higher than many peers. The general investment belief is that the brand is highly successful at building a cult following and commanding premium prices, but the risk lies in its relatively narrow focus, high price point, and the sustainability of its cool factor against behemoths like Nike and Adidas. The past few months of stock performance, where the price declined over 30% from its year-to-date highs, reflected the fear that the cool factor was fading and the narrow focus was becoming a limiting factor in a tougher economic climate. This sell-off put the stock near its 52-week low just before this morning's report. The deeper take that today's results introduce is the structural shift happening internally. The massive beat in gross margin, reaching a new high of 65.7%, is not just luck. While they cited a one-off positive impact from lower freight costs, the sustained strength suggests a fundamental improvement in supply chain efficiency and product mix, potentially moving more volume toward those higher-margin apparel and accessories. This is where the contrarian argument gains traction. The consensus view that ON is limited by its high price point and niche status is challenged by the fact that they are simultaneously growing their apparel business at a blistering pace and seeing outstanding traction in Asia-Pacific. If you are a client of Schwab Intelligent Portfolios or managing your own finances through Robinhood, the narrative of a simple running shoe company is inadequate. You're looking at a budding global lifestyle brand that is proving it can broaden its appeal and, crucially, maintain exceptional profitability even when the general investment environment is cautious. What's next for On Holding AG? The future outlook is now colored by a significantly raised full-year guidance across net sales, gross margin, and adjusted EBITDA margin. This is the single most important component for future online investment decisions. Management is now expecting net sales growth of 34% year-over-year on a constant currency basis, up from at least 31% previously. More importantly, the gross profit margin is now projected to be around 62.5%, a substantial hike from the previous 60.5 to 61.0% estimate. This guidance is a powerful endorsement of their confidence that the strong performance is sustainable, not a fluke. Potential scenarios include a rapid return to the upper end of the stock's trading range, potentially testing resistance points set earlier in the year, particularly as institutions play catch-up. Analysts who reiterated underperform ratings, citing concerns about limited total address market and renewed competition, now have a much harder case to make when the company is delivering this level of organic growth and margin expansion. The catalyst moving forward will be the continued success of their apparel line, the execution on new retail store openings in key global cities like Zurich and Tokyo, and the performance of their major athlete endorsements in high-profile races, which provides organic, authentic marketing. Of course, risks still exist. The market remains volatile, and a general recessionary environment could eventually impact their premium consumer base regardless of brand strength. Furthermore, the reliance on third-party manufacturing introduces supply chain risks, although they seem to be managing it well currently. The Americas region remains the primary concern, with the growth not meeting some internal expectations, suggesting that while the global story is strong, the most important consumer market is showing signs of fatigue. This is a critical point that needs to be monitored. A slight slowdown in U.S. wholesale distribution could easily spook investors who were burned by the last earnings miss. It's also crucial to remember that the athletic apparel space is always a battlefield, a place where NVIDIA stock's chip technology struggles are worlds away from the fashion and design competition against players like Lululemon and the dominant force of Nike, which is actively trying to reclaim market share. For those of you tracking this space and looking for investment help, consider the dual-class share structure of ONON that ensures founders and key executives maintain substantial control, a factor that can sometimes be viewed as a risk regarding shareholder democracy, but also stability of vision. The underlying theme remains, can this growth company, trading at a premium valuation even after the pullback, sustain its growth trajectory? Today's earnings say yes, much to the market's surprise. The reality is that the brand resonance and geographic diversification are providing a robust shield against the macroeconomic slowdown that has clipped other brands. This is a business successfully transitioning from being a niche running shoe brand to a broader premium sportswear player, and that narrative shift fundamentally changes its valuation ceiling. I want to hear from you directly. Comment below which on-holding AG product, shoes, apparel, or accessories you think will drive the most revenue growth for the company